What happens when the system that powers everything suddenly stops moving? You don't lose money all at once. You lose the ability to use it. It is still dark in Ohio. The line is already 3 miles long. Engines idle in the cold pre-dawn air, then shut off to save what little fuel remains. Men sit with both hands on the wheel, watching the brake lights ahead glow red through the frost. Someone has brought a thermos. Someone else is walking car to car asking whether the station is even still open. Nobody knows. That is the first sign the system is breaking. Not the price, not the speech from Washington, the loss of certainty. A week earlier, this still felt temporary. An inconvenience, a foreign crisis that would stay foreign. But now, school schedules are shifting. Deliveries are late, factories are slowing, and ordinary people are learning a hard rule of financial history. When energy stops moving normally, nothing else stays normal for long. This is the part most people forget about the oil shock of 1973. It was not just an oil story. It was a story about hierarchy. Who could still get to work? Who could still heat a home? Who could still move inventory? Who discovered, too late, that a bank balance, a pension statement, and a respectable stock portfolio are not the same thing as usable security? The official language was temporary shortage, market adjustment, necessary patience. The forensic record says something harsher. Everything worked as long as energy stayed cheap, and then it didn't. A modern industrial society had built its daily life on cheap, continuous energy flow through vulnerable corridors. Once that flow was interrupted, the damage did not remain at the gas pump. It moved into wages, savings, transport, inventories, confidence, and eventually into the definition of wealth itself. And conservative savers who thought they were protected were about to learn they were standing in the most exposed position of all. In 1973, the disciplined saver believed they had done everything correctly. They avoided speculation. They held cash in the bank. They accepted modest returns around 4 to 5% because safety, not excitement, was the goal. This was a social contract. Defer consumption, earn interest, preserve purchasing power. On paper, it was rational. In reality, it was a trap, because the system they trusted assumed something that had already begun to fail: stable energy costs. Every interest rate, every pension projection, every bond yield was quietly built on the expectation that the physical world underneath the financial system would continue to function smoothly. It didn't. When oil prices began to surge, the effect was not contained to fuel, it propagated outward. Transportation costs rose first, then food distribution, then manufacturing inputs, then retail prices. Inflation did not arrive as a single event. It spread like pressure through a closed system, showing up everywhere at once, but explained nowhere clearly. The saver continued to earn 4–5%, but inflation moved past 8%, then 10%, then higher. At what point do you realize you're not saving? You're bleeding. This is where the damage becomes invisible. No account balance declines. No red numbers flash on a statement. The saver still sees growth, still receives interest, still believes they are holding steady, and that illusion is exactly what destroys them. But in real terms, they are losing ground every single day, quietly, systematically, without a single transaction. Meanwhile, a different class of participant behaves very differently. The so-called reckless, those holding hard assets, commodities, or leveraged positions tied to real goods, experience volatility, even temporary losses. But they are positioned inside the inflation, not outside it. Their assets reprice with the system, not against it. This is the inversion that shocks people when they finally see it clearly. The careful are punished, the exposed are protected, because the real dividing line was never risk tolerance. It was proximity to physical necessity, and energy sits at the center of that necessity. Once its price is no longer stable, every financial promise built on top of it begins to drift away from reality. The saver does not notice immediately, but by the time they do, the gap between nominal wealth and usable wealth is already too wide to close. The break did not begin at the gas station. It began at a narrow stretch of water thousands of miles away. In October 1973, following the outbreak of the Yom Kippur War, oil-producing nations made a decision that redefined modern economic vulnerability. Members of OPEC imposed an embargo targeting countries perceived to support Israel, including the United States. But the embargo itself was only the visible layer. The real mechanism was control over flow. Energy doesn't move freely across the world. It moves through choke points, narrow corridors that concentrate enormous power into very small spaces. Global energy does not move evenly across the planet. It travels through constrained corridor shipping lanes, pipelines, and maritime choke points that concentrate enormous strategic power into very small geographic areas. When those corridors are restricted, even partially, the effect is nonlinear. Supply does not decline gradually. It fractures. One of the most critical of these corridors is the Strait of Hormuz, a narrow channel through which a significant portion of the world's oil must pass. Another is the Suez Canal, a man-made artery that shortens global shipping routes by thousands of miles. When these points are threatened, whether by war, embargo, or political leverage, the system does not have time to adapt. Tankers reroute, distances increase, insurance costs spike, delivery schedules collapse, and most importantly, the assumption of continuous supply, the invisible backbone of industrial society, breaks. This is the moment energy becomes a weapon, not through destruction, but through denial. In 1973, the United States did not run out of oil in absolute terms. What it lost was distribution reliability. Refineries could not plan, gas stations could not predict deliveries, consumers could not trust availability. And once trust disappears, behavior changes instantly. People hoard, stations ration, governments intervene, and markets designed for equilibrium are forced into panic. The price of oil did not simply rise, it quadrupled. But even that number understates the damage, because the real shock was not the cost itself. It was the speed, the unpredictability, and the realization that energy previously treated as a background constant was now an active, strategic variable. A lever. And once a system reveals that it can be controlled through a single point of failure, it is never perceived the same way again. The lesson was clear, though rarely stated directly. Modern economies are not resilient networks. They are tightly coupled systems, dependent on uninterrupted energy flow through a handful of vulnerable gates. And those gates can be closed. Once energy prices broke, everything built on top of them began to misprice at the same time. This is where the damage accelerated. Oil did not rise in isolation. It reset the cost structure of the entire economy. Every mile driven, every shipment delivered, every input manufactured began to carry a higher embedded energy cost. But wages did not adjust at the same speed. Contracts did not reset overnight. Financial models did not reprice instantly. So the system entered a phase of distortion. At first, it looked like ordinary inflation, prices rising unevenly, explanations shifting from supply issues to policy responses. But underneath, something more dangerous was unfolding. Corporate margins compressed, inventories became harder to finance, transportation delays created cascading shortages, and central banks, facing rising inflation, were forced into a corner. They had to stop inflation. But stopping inflation came with a cost. To contain it, they had to raise interest rates. And the moment they did, something else started to break. Higher rates increased borrowing costs across the economy. Credit tightened, right when businesses needed it most. This created a feedback loop. Higher energy costs, higher inflation, tighter policy, weaker activity, falling asset values. The stock market did not collapse all at once. It bled. Between 1973 and 1974, major indices lost a substantial portion of their value. But again, the visible losses were only part of the story, because even where nominal prices held temporarily, inflation eroded the real value underneath. This is where paper wealth reveals its fragility. A stock certificate represents a claim on future earnings. A bond represents a promise of fixed payments. A savings account represents stored purchasing power. All three depend on stability of currency, of cost structures, of expectations. Energy shocks destabilize all three simultaneously. Companies cannot maintain margins. Fixed payments lose real value. Cash decays quietly through inflation. And then comes the second-order effect, forced selling. As costs rise and liquidity tightens, participants begin to liquidate assets, not because they want to, but because they must. Businesses sell inventory below optimal prices. Investors exit positions to cover rising expenses. Institutions rebalance under pressure. This is how a price shock becomes a wealth transfer. Not through a single crash, but through a series of constrained decisions made under stress. Those holding purely financial assets are pushed into the market at the worst possible moment. Those holding physical, scarce, or essential assets are not. They can wait. They can reprice. They can operate inside the inflation instead of being eroded by it. And this is the dividing line that defines who is forced to sell and who is able to hold. Because in an energy shock, liquidity is not neutral. It becomes a weapon that turns time itself into an advantage for one group and a liability for another. It is tempting to file 1973 away as a historical anomaly. A different era. A different geopolitical structure. A crisis tied to a specific war, a specific cartel, a specific moment in time. But the underlying architecture has not changed. If anything, it has become more fragile. It's tempting to think this can't happen again, that it belonged to a different era, a different system. It didn't. And the system now is even more fragile. Today, the global economy runs on a far more complex energy grid, more interconnected, more optimized, and far less forgiving. Supply chains are longer, buffers are thinner, everything moves faster, and almost nothing has room to break. But the real change isn't just physical, it's structural. The system has multiplied its points of failure: electrical grids, semiconductor supply chains, undersea cables, energy export terminals, not fewer choke points, more of them, and all of them connected, which introduces a harder question. What do you own that still works when the system doesn't? Because disruption doesn't need to be total. It only needs to be enough to break predictability. And once predictability is gone, behavior changes instantly. Companies stop trusting supply, so they hoard. Nations stop trusting markets, so they restrict. Logistics stops being reliable, so it slows. And financial markets, priced on stability, begin to detach from reality. This is where most investors make the same mistake as 1973. They assume diversification protects them. But diversification inside a system is not protection from the failure of that system. Because if everything depends on the same foundation, then everything shares the same weakness. Stocks, bonds, real estate, even digital assets, all of them require the same thing: functioning infrastructure, reliable energy, continuous flow. Remove that, and correlation moves toward one. Everything starts behaving the same way: down, illiquid, or inaccessible. The question is no longer whether an energy shock can happen again. It can. The record already proved that. The real question is simpler: where are you positioned when it does? In every energy shock, survival is not determined by intelligence, effort, or even discipline. It is determined by positioning. The historical record is consistent on this point. Those who held assets entirely dependent on the financial system bank deposits, long-duration bonds, equity portfolios, were forced into passive loss. They could not accelerate their response. They could not exit without penalty. They could only watch purchasing power erode or sell into weakness. Those who held assets tied to physical necessity operated under different rules, not perfectly, not without risk, but with options. Physical gold did not produce income, but it preserved exchangeability when currency confidence weakened. Short-duration debt allowed capital to reset more quickly to rising rates. Productive land, especially agricultural land, did something more important than either. It continued to produce. Food did not require a functioning stock market. It did not depend on investor sentiment. It moved through local systems even when national distribution faltered. In a period defined by scarcity, production itself became a form of monetary power. But there is a condition most people miss. These assets only provided protection when they were outside the reach of forced liquidation. Not margined, not leveraged, not dependent on continuous liquidity. Because the moment an asset is tied to a liability that can be called, it stops being a refuge and becomes collateral. This is the final pattern. Energy shocks do not just raise prices. They expose which forms of wealth are real and which are conditional. The official response will always promise stabilization, strategic reserves, coordinated policy, temporary disruption. Sometimes those measures help. Often they arrive too late. So the decision is simple, but not easy. You can hold claims inside a system that requires uninterrupted energy flow to function. Or you can hold assets that remain useful when that flow is strained, rationed, or redirected. One depends on stability. The other survives its absence. Because the system doesn't warn you before it breaks. It just stops. And when it does, what you thought was safe is the first thing to fail.